Index funds are a type of investment fund that aims to track the performance of a specific market index, such as the S&P 500. They are designed to provide broad market exposure, diversification, and low-cost investing for individual investors. Index funds are investment funds that aim to replicate the performance of a specific financial market index, such as the S&P 500. These funds invest in a diversified portfolio of stocks or bonds that mirror the composition of the chosen index. By doing so, they provide investors with exposure to the overall performance of the market, without requiring active management by fund managers. Experts believe that index funds offer diversification benefits by providing exposure to a wide range of assets within a single investment vehicle. This can help reduce the impact of individual stock or sector fluctuations on overall portfolio performance. Index funds offer a cost-effective investment option for long-term financial growth due to their low management fees and ability to track the performance of a specific market index. Their passive management style and diversification across multiple securities often result in higher returns compared to actively managed funds. When comparing index funds with actively managed funds, it's important to note that index funds aim to replicate the performance of a specific market index, such as the S&P 500, with low costs and minimal turnover. Actively managed funds, on the other hand, are managed by professionals who attempt to outperform the market through active buying and selling of assets. While index funds generally offer lower fees and more predictable returns, actively managed funds may offer the potential for higher returns but often come with higher expenses and increased risk. Case studies and real-life examples of successful long-term investing in index funds showcase how investors have achieved consistent growth and passive income over time by simply tracking the performance of the market. When choosing index funds for long-term investment strategies, it's important to consider factors such as expense ratios, diversification, and historical performance. Look for funds with low expense ratios to minimize costs and ensure a greater portion of returns are passed on to investors. Additionally, opt for funds that provide broad diversification across different sectors and asset classes to reduce risk. Lastly, analyze the historical performance of the index funds to gauge their consistency and potential for long-term growth. Investing in index funds for the long term offers the key advantage of diversification, which helps reduce risk by spreading investment across multiple assets.